So let's talk about the pros of holding individual stocks. Well, the first of the pros is that when you buy an individual stock, it's reduced fees relative to purchasing a mutual fund or an ETF. And that is very true, because if you aren't allowing somebody to manage the money for you, or if you're not paying a fund manager some certain amount, then you can trade for basically free when it comes to most of the investing platforms out there now. So buying individual stocks is going to be definitely reduced fees, but is it worth the likely reduced returns? Because most people can't beat the market over the long term net of fees. Now, this said, the longer that you hold any stock, the lower the cost of that ownership is. And since fees do have a big impact on returns, they definitely do. Jack Bogle was a big advocate for the fact that you need to decrease fees if at all possible. And you definitely do, because they can eat away at returns. Given that that is the case, holding individual stocks can be extremely useful because you don't have to pay the fees that would eat your returns over time. So if you can hold them for a long period of time and you have a good basis for purchasing them, then that can be a big pro of holding individual stocks. Now, also a pro is that you understand what you're purchasing. Now, this is a very dangerous assumption because a lot of individuals do purchase individual stocks and they don't know what they purchase. They don't understand what the company does. They don't understand how the company makes money, and that is an issue. We need to understand how these companies make money. We need to understand why we purchased the stock, what the value of the stock was. And if you can't determine those things, if you don't know the basis on which you purchased the stock other than feeling good about it or liking the CEO, then that's an issue. But if you do your homework, you can understand what you're purchasing a lot better than purchasing a mutual fund or an ETF of any type, because there's only one thing to focus on. There's only one company to focus on. And if you understand that company and understand how they make money and understand their value, then you understand them a lot better than you would thousands of companies in a mutual fund or an ETF. Not to mention, all of the control of what you're invested in is in your hands, not in some fund manager's hands, which can give you peace in your investing journey because you are the one making the decisions, and win or lose, it's on you. And then the third pro of owning individual stocks is you can manage your taxes a lot easier with individual stocks than you can with funds. Now, why is this the case? Well, you're in charge of when you sell. And if you remember when we talked about capital gains taxes and having to pay individual income tax if you sell within a year and realize a gain, then you'll remember that we talked about how when you sell and you have some type of gain, it triggers taxes if we're talking about an account that is not a tax advantaged account like an IRA, a 401k, things of that manner. So when you purchase individual stocks, what you'll be able to do is to determine when you want to sell, and you can sell in order to minimize your tax liability. And that can be a really useful thing, but it can also get out of control because you might just be focusing on your tax liability and not the company as much as you should. But nonetheless, you will get to have control over how much taxes you pay when you pay those taxes. Whereas with like a mutual fund, the fund manager can make a decision to sell within the fund and make a distribution to you that is taxable. And that can be an issue and can create some undue taxes. Now, purchasing index funds, this happens a lot less often, but still, if there is turnover within the index, then you will still have that same thing going on. Whereas if you purchase some individual stocks and don't sell any of them, then you will not incur any taxes whatsoever. Now, this is where I really want you to perk up and listen, because the cons of owning individual stocks on a broad basis can definitely outweigh the pros. And I'm not saying to not own any individual stocks. I do it. I have done it. It's a game that you can win at, you can do well at, but it takes a lot more work, takes a lot more time, takes a lot more of your energy, and maybe you don't want to put that into things. Then don't buy individual stocks. And I feel like most people don't want to put that time and effort in, then don't buy individual stocks. And we're going to talk about why here. So, first of all, hard to achieve diversification. We've talked about diversification. We understand that diversification has to do with having all your eggs in one basket or spreading your eggs out into different baskets, right? Diversification has to do with instead of just buying large company stocks, then you're buying small companies and emerging market stocks and value stocks and growth stocks, different types of stocks, different types of securities within the same asset class. That is how we go about diversifying. Now, depending on what you study, you must own between 20 and 100 stocks in order to have proper diversification. That can be extremely costly for the individual owning individual stocks. And honestly, if you want to own individual stocks that you understand and that have a high likelihood of increasing in value over time, and you'll be able to hold them for the long term, then owning 100 stocks is not necessarily what you're probably looking for. And so you will lack proper diversification in most cases. Now, if you go back to, they call it modern portfolio theory, right? What this would mean for you if you don't fully diversify, if you don't minimize risk for the maximum return, then what that would mean is that you would be taking on more risk for a certain amount of return than was necessary, which can be a distinct con. And then let's not forget that individuals that don't have much money to invest are really going to struggle in this place of trying to diversify and trying to minimize risk, because they don't have the money to buy the stocks and weight the stocks in the way that they can go ahead and have enough in different types of stocks and diversify out the risk well. They're just not going to be able to do so. And so diversification is just such a hard thing with individual stocks, and it is even harder when you don't have a ton of funds in order to create your own little portfolio and have a bunch of different stocks and in varying amounts and things like that. It's just going to be far more difficult for you as an individual stockholder. Now, these last two are the reasons why I say most people shouldn't invest in individual stocks. These are the two that you need to focus on. So these last two cons, the first of which is it requires more time for you to monitor your portfolio. You may say, well, that's a really simple thought. Why is this such a big deal? Well, you have to ensure that the companies that you purchase are of good value, that you purchased them at a good price, that they remain of good value, that they are going to continue to grow over time, that you're going to get your required rate of return, whatever that is for you. And if you fail to do that, then you can definitely lose a lot of money. So you have to be willing to do the research. You have to be willing to put the time in. If you don't put the time in, then you will definitely get bitten when it comes to individual stocks. And this is also going to require you to keep tabs on economic trends and industry trends and understanding what other companies are doing and if other companies are better uses of your money than the ones that you're holding. And all of these considerations come into play, and it's going to eat away at the time that you have during the day. And there's not a bad thing if you like it, but a lot of people don't want to deal with that. And if you don't want to deal with that, I would not suggest investing in individual stocks. And then let's not forget that you're your own portfolio manager. You have to decide what's a good position and what's a bad position. You can't take a position based just on your feelings, based just on how you think something will go or how something is hot or something is cold. You can't do that. You have to make decisions based on rational thought. And then that leads me into the final con of investing in individual stocks, and that is you must keep your emotions in check. Sounds like an easy thing to do. It is extremely hard. I've talked previously this week about market crashes and how market crashes tell you who you are as an investor. They reveal who you are as an investor. And what I meant was that they reveal how emotional you get about the movement in stocks, how emotional you get about the movements of the market. And it becomes really, really easy as an individual stockholder to sell a loser and buy a hot stock tip, because you can instantly lag the institutions and individuals who are trading on something that's hot already, and you're going to lose returns over time by doing that, by playing on emotion.